But before we just jump into that, I just want to answer a question here from I can't pronounce the name, Qing Yutan. Just wondering how to interpret the move. So just to anybody who doesn't know, the move is essentially the VIX index for bond market. And what we're seeing right now is that the move is increasing pretty significantly. So the one-on-one answer to that is that we're getting volatility within rates, right? Anywhere from the 1 month rate all the way up to the 30-year, we're getting a pretty big volatility. And the volatility is showing itself as a bear steepener. That means the shorter dated rates, so 1 month to, let's say, 2 years, are falling or low, while the long-term rates are rising. What does that mean? That means that the bond market is pricing in that we're going to have inflation concerns in the future, but that the short-term rates are lower or falling because they're saying that the monetary policy will be that of easing, that they're going to be making credit as easy as possible now. So that's bad news bears for inflation down the road. Another feather in the cap of I think we're going to see the 12%, 15% inflation in the next within the next 2 to 5 years. We'll see what happens there. But the bond market is making that bet. What does that mean for us as retail traders? It means that we need to take short-term bets. We need to think in the next 2 quarters, the next 6 quarters, and that we shouldn't be placing any bets on that we're thinking that that volatility essentially needs to resolve itself in the market. And the way it'll resolve itself in the market is that we'll no longer have this uncertainty of the future, or at least that uncertainty of the future will be there for so long that we'll just get used to it. Do you trade or do you pay attention to the move index?
I do, yeah. And I have been, I have an overlay chart on all short-term and long-dated yields and treasuries as well. I'm usually keeping track of the Fed funds rate as well as the general mortgage market or average 30-year mortgage rates. So as I take a look at just the overall move across all of the yields that are available, or at least the terms for each of the treasuries, it is interesting to see that some of the long-dated yields are moving up rather quickly. I think that it can be explained in a few different ways. Some of it is an expectation of an increase in inflation, pricing in the probability of a Trump win. Some of it very much could be just the uncertainty that we're describing here about the outcome of the election. As we move past November 5th, I would expect that the market will start to react to a different regime there. I'm definitely in line with Ken Griffin's recent comments around the uncertainty right around these moves, or right around these points of an election. So I do think right now is just uncertainty more than anything, and some of that uncertainty is starting to show up in the form of volatility, particularly in the move.
That's right. So I'm looking for that move to go down before I believe the inflation is not going to pick back up. I see no reason why the 10-year or the move index are not telling us exactly what we need, what's true, or that gold or the dollar rising. All these are worries within the financial system. But I'll save my doomsday for when I do a doomsday channel. When I can't be a successful trader anymore, I'll start off a Peter Schiff type channel and just go on and on about how the world's going to crumble.
You can bring your doomsday here, and you and I will balance each other out. I'm probably not concerned enough.
Right. Well, you're on the 20th floor of a building with an amazing view behind you. I'm sure you're not worried enough about the future. All right. Well, speaking about not being worried enough for the future,